Hey, what's going on, guys? Today I want to make a quick video talking about, the importance of closing spreads before, the expiration. So if you understand what a put spread is, obviously you're using margin to conduct this trade because normally to sell cash secured puts, you're going to have the cash to sell the naked put. Excuse me. And this example, the QQQ 389 put would require $38,900. So, if you have that amount of cash in your account, then don't worry about, closing the spread early, just because, if you do get shorted on, if your short does get hit by expiration, then you're going to be covered. But the problem is with spreads, a lot of the times we leverage out our accounts to the point where we don't have enough cash to cover the short position. So the 389 here. And that is why you normally buy the insurance, the 387 put. So, our theoretical collateral and, max loss here is $200 and then subtracted by whatever credit we would have received for this position. But the part that I tried to emphasize and explain to new traders is that is the typical, and most of the time that is the case. But do remember that trading options and this particular strategy, there is a little bit more risk that you need to manage. A lot of the times brokers will manage it for you. I know Robinhood, I kind of got stumped out of a position last week. They thought with their risk algorithm that the current position was just too risky to continue to hold. So at 3 p.m. Eastern, they closed out my spread. I was actively monitoring it, and I told them hey, don't close it out because, I would roll it or, buy it back before the end of the day, but that apparently didn't work. And the sad part is the spread ended up being out of the money by $2 or $3, and I essentially just took a loss that I couldn't do anything about. So do keep that in mind. Robinhood and other brokers will, close your position a lot of the time just to, cover themselves, because to think about it, they do have a huge margin responsibility, so they have to make sure that they can cover theirself as well. So back to this example here. So this is just the QQQ NASDAQ 100. This isn't investment advice, so be sure about the stock or ETF that you're trading before you ever open a spread. But yeah, QQQ, I like it. It's similar to SPY in the fact that it has 3 expirations per week, and it's a very liquid ETF that I enjoy doing vertical spreads on. So as you can see here, this option is expiring today. Nothing crazy, a very simple. I was really just doing this for an example purpose today. So I bought it I sold it yesterday, 10 minutes before the close. It was a 1-day DTE expiration, so not a lot of credit here, but it was $5 on a $200 spread, so about 2.5%, give or take, trade here. So nothing crazy, but what I wanted to display and talk about is closing this short position. So you can see here, this short position is the 389. And this is what I was talking about earlier. So essentially, QQ's plenty far away from the short position, but markets can change very quickly. And do keep in mind that options don't technically expire until 5:30. So you can't buy or sell the positions after 4 p.m., but people can still exercise these options before 5:30. So an example, say the QQQ closes at 390. At 4 p.m., it closes at 390. Great. My short position is out of the money. Theoretically, it's out of the money. But in after hours, say it tanks by, I don't know. So it's at 390 and it drops to 388. So now the ETF is in between the two strikes. So like I was mentioning earlier, this is a very dangerous situation, and the amount of loss that you could expect here could be a significant amount. I made a video earlier this year talking about how I had heard this similar situation happen with someone trading like a Tesla spread, and they lost, thousands and thousands of dollars, like $20,000 or $30,000 on a position or a trade that was only supposed to be a max loss of 500 or so. So to keep that in mind, what would happen? You would be exercised on that 389 put. So I'm sorry, the option buyer would exercise the 389 put. So you would be obligated to, fork up that $38,000. But the problem was, now the 387, it's at 388, so you can't exercise that for insurance. So not a good situation. I'm not sure exactly what would happen. Because a lot of the times brokers don't even know that this has happened, and you may not even know about it until Monday, the following week, or, the next trading day, whatever it may be, Monday, Wednesday, Friday. So yeah, guys, and, obviously you could just buy the spread back. Sorry. You would close it, buy it back for $1 or $2 or whatever. But if you're like on another broker and you don't want to necessarily pay that extra commission, obviously I think it's totally worth it, taking that risk off the table. 60 cents or $1, whatever the commission is, would totally be worth it. An alternative thing you could do is just buy back the 389. So this is the position that you're shorting. So, obviously if you're doing a call spread or other types of spreads, you want to close your short position. So Robinhood makes it really easy. You would just come back in here. Since you sold it to open it, you would just buy it back for $2 or $1. I think that's kind of like what I currently have set up here. No. Let me buy this back and close it for $1. Okay, and it actually got filled there. So I closed my position. My risk is off the table. Now I just have this 387 put. I can try to get this closed for a penny. I doubt it'll get filled. Probably no buyers at this level yet. So more than likely, this will just expire. I doubt anyone's going to pay to buy that right now. But yeah, that's pretty much the extent of it. So my risk is off the table. Did that just get executed? No, I don't think it did. But yeah, my risk is off the table. I don't have to worry about, after hours. I've collected, almost 98%. So technically I sold it for $5 and I bought it back for $1. So yeah, that would be my profit there. But yeah, guys, that's pretty much it. This is, can be applied to put credit spreads and call credit spreads. So do keep that in mind. Always know your risk before doing these types of spreads. I would hate to see anybody lose that significant amount of money just because they didn't close the spread for $1, or, they didn't just take their losses and roll on to a new position, or hoping that it will recover. So do keep in mind, this is not financial advice. I'm not a financial professional, so do keep that in mind and do your research before taking on these type of option positions. And that is it for this video, guys. I hope you guys watched it. I know it's been a couple months. It's been crazy on my end. But yeah, I'm hoping to push out some more content for you guys here. So, all right, guys, that's it for this video. Thanks for watching.